Hello, everyone. My name is Nevin Akaydın. Welcome to our Path to Home Ownership program. Tonight's presenter is Alessandra from Habitat for Humanity. Thank you, Alessandra, for your time and being with us tonight. Stage is yours.
Thank you, Nevin, for having me. I'm happy to be here, and thank you everybody for joining us. Again, as Nevin said, my name is Alessandra, and I am a housing counselor, and I work at Habitat for Humanity East Bay, Silicon Valley. And welcome to Path to Homeownership. So let's just talk briefly about our programs before we go into the home buying process. Habitat East Bay Silicon Valley is a nonprofit, and we serve people in Alameda, Contra Costa, and Santa Clara counties through 3 programs. We offer affordable homeownership opportunities. We build new homes and renovate existing homes and then sell them at an affordable mortgage to qualified families with limited and moderate incomes. We also offer housing counseling services. And through our owner-occupied home repair services, our home preservation program provides grants and low-interest loans for low-income homeowners throughout our service area. Just a little bit about our housing counseling program. It's certified by the U.S. Department of Housing and Urban Development, known as HUD. And our services include one-on-one counseling, financial education workshops like the one we're presenting tonight, HUD-approved first-time homebuyer classes, and online financial education. Now, one-on-one counseling offers free individualized guidance. Clients work with a dedicated HUD-certified housing counselor and learn strategies for managing personal finances, including how to create a sustainable household budget, start a savings plan, manage debt. We also offer credit counseling that teaches how to understand the credit report and how to build or rebuild positive credit history, as well as home pre-purchase counseling to help understand how the home buying process works and how to become financially ready to buy a home. And we offer monthly financial education webinars like the one we're presenting today. Are free. We present them also through our directly from our website. You can register. We offer a couple of topics per month, and then we offer free online free financial education center, which is an online library of interactive lessons that you can take at your own pace and at your own time. They cover a variety of financial education topics, and I'll talk a little bit more about this when we get towards the end, and I'll give you also the link to it. But today we're going to be covering advantages and disadvantages of homeownership, preparing for homeownership. We'll talk with lenders about what lenders look for when you apply for a home loan, and then we'll go over some home loan programs and products. Now, buying a home is probably the largest financial transaction you'll make in your life, and it's a long-term financial commitment. So it's very important that you weigh all the pros and cons and carefully consider all the responsibilities that come with homeownership. Now, let's talk about benefits of homeownership. One of the benefits is that the housing costs are more stable than when you rent. While rent typically increases year after year, if you have a fixed rate mortgage, means that the principal and interest portion of your monthly housing payment will remain the same until the mortgage is paid in full. And we'll talk more. We'll talk more about the fixed rate mortgages and all that. But now the amount that you pay for expenses like property taxes, homeowner insurance, homeowner association dues, those may increase each year, and they typically do. But they don't increase as much as rent can or as often. And so it makes it easier to budget for housing cost over the long term. You also have tax benefits as a homeowner that you do not have as a renter. The amount you pay each year for interest and property taxes are deductible items. Tax laws have changed. So there's caps to how much you can deduct, but you could talk with a tax accountant to see if it makes sense for you. financial sense for you, but but the bottom line is that you do have these tax and benefits that for sure you don't have as a renter. Equity is another benefit of owning a home. Equity is the difference between what you can sell it for and what you owe. Now, over time, your home may increase in value. And as you make your monthly payments, the amount you owe decreases. So with the increase in value and the decrease in the amount of debt that you owe, your equity will grow. You also have control over your environment. You get to decorate it the way you want. You can have pets. You can adapt your space to your individual style and needs without having to ask for permission. And there's also a certain size of pride when you own a home. And it's not to say that you do not feel proud of your home when you're renting, but buying a home is not easy. It's a really lengthy process. It takes a lot of work and preparation. And so it's an achievement that people work hard to obtain. And then there's a sense of pride when you reach that goal. Now, there are also disadvantages, though, that come with homeownership that you must carefully consider. Buying a home, again, is a very, very large financial transaction, and it's a long-term financial commitment. So as a homeowner, you'll have costs that you don't have as a renter. And so careful budgeting is critical, not just while you own the home, but also before you buy the home. So before taking a mortgage loan, you must make sure you'll be able to cover not just the monthly mortgage payment, but other costs like utilities, property taxes, homeowner insurance, homeowner association dues if your home is in an HOA. If you put less than 20% down as a down payment, you'll also have to pay mortgage insurance. Now, not keeping up with all these costs carries serious financial and legal consequences. Not only do you risk losing your home and investment, if you end up foreclosing on your credit, your credit history will suffer greatly, and it will take a long time to recover. As a homeowner, having a healthy savings reserve and adding to savings every month is critical. You must make sure that you are protected. So should an emergency arise, like a job loss or an emergency expense, like a car or home repair, you're still able to pay your mortgage and HOA dues and homeowner insurance and all those costs. You also have decreased mobility, and that's because it's not as easy to pick up and move. When you rent, generally the longest time you commit to live in the home is 1 year, and often it's month-to-month commitment, and all you need to do is give a 30 days notice. But when you own a home, if you have to move, you would have to go through the process of selling it before you're no longer obligated to pay the costs that are associated with owning that home. Now, that means that you also may not be able to afford adding another housing payment to your current obligations. The mortgage debt may also make it harder for you to qualify for rent wherever you're moving. There are other factors to consider. The market may be soft, which means the homes are not selling well, and so it could take you a long time to sell it. Or the housing market is in a downturn, and if you were to sell the home, you would lose money. Like any investment, buying a home is a risk. So you could build equity, but your home value is tied to the market. And so it could also lose value. And you could end up owning more than the home is worth. When you purchase a home, you also have a high one-time upfront costs that you must cover before you even get the keys to the house. You'll have to pay a down payment, which depending on the program can be anywhere from 3% to 20% of the purchase price of the home. You'll also have to cover closing costs, which as a rule of thumb are usually about 2 to 5% of the purchase price. And then after paying these high upfront costs, you need to also cover moving expenses, not just renting a U-Haul or hiring movers, but also appliances that you may need to buy, like the refrigerator or washer and dryer. It's also important to consider how long you plan to live in the home, because if you have plans to move soon, you want to keep in mind that it takes about 3 to 5 years to break even after paying the high upfront costs that come with purchasing a home. And of course, there are responsibilities that come with homeownership. In addition to the housing costs we just reviewed, you must make sure that you make all your payments on time. Of course, the mortgage payment, but also mortgage insurance. If you put less than 20% down, if your home is in a homeowner association, those monthly dues, you have to pay them every month. They aren't optional because if you don't pay them, you run the risk of losing your home through foreclosure. When you rent, although renter's insurance is highly advisable, you're not typically required to purchase it. As a homeowner, you will be required to carry it and keep it current. And if you don't, you would be in breach of contract and might face added cost and eventually even foreclosure. Of course, when you own the home, you can't call the landlord to come and fix things. So you need to take care of repairs and maintenance on your own. You're responsible for scheduling them and covering the cost. And you will have a by contract agreement with the lender that you will keep the home in good repair. The mortgage loans typically have a provision, and this that you agree you agree that you will keep the home in good condition, and that including the yard if the home has a yard. Now, if you don't, the lender can make the repairs and charge you interest, or can foreclose on your home if you don't make the repairs after the notice. Also, when you buy a home, you become rooted in a community. This can be a very good thing. However, it does come with responsibilities. It isn't as likely that your neighbors are going to be moving anytime soon. And so you must make that extra effort to get along and work through differences. And if the home isn't an HOA, then you need to follow its rules. You need to attend meetings and participate to make sure that your community thrives and decisions are made that also are in line with what you think is right. And so you need to be an active participant. Now, before you even consider buying a home, you need to analyze your financial situation. Are your income and expenses balanced? You'll have those additional monthly costs that you'll have to cover. So if you're struggling now to keep up with your current expenses, then you need to carefully consider whether you should take on the added financial responsibility of owning a home. Your monthly mortgage payment may be higher than what you're currently paying in rent. Again, you'll have those property taxes, some insurance that you have to pay for, utilities costs will likely increase. You may have HOA dues that you have to pay, mortgage insurance. If you don't put 20% down, you'll have to pay that as well. So you want to make sure that your budget can easily sustain the added cost. Now, the other thing you want to make sure that is your income, is stable. If you change job frequently or your income varies a lot from month to month, then you risk not being able to keep up with all the monthly housing expenses. Do you have money in savings to cover the down payment and closing costs? You want to make sure you have enough, and you want to make sure that after paying those upfront costs, that you are left with a reserve, that you're not left with no money left in savings, and that you would have enough left to cover any kind of personal household emergency. So you don't want to drain your bank account just to be able to purchase that home. Are you adding to savings every month currently? If not, that's a red flag. As a homeowner, savings is being able to save is even more important. It's always important, but even more so when you own a home. You need to make sure that you have a good safety cushion that you can rely on should you have an emergency expense or an emergency situation like the loss of a job, so you can continue keeping up with all your housing payments, payments related to the home, and of course all your other critical expenses. And when you own a home, you have, because you have to cover repair and maintenance, you will have maybe emergency maintenance that all of a sudden you have to cover, like a roof that leaks, and so you want to make sure that you've got that cushion that you can rely on. So if you're not able to save right now, then that's kind of a red flag. You need to make sure that you are comfortably being able to save. And then how much debt do you currently have? If you are overextended, if you have a lot of debt currently, then you really want to think whether you want to add more debt. So you want to make sure that you are the debt that you, are carrying a debt that you can comfortably keep up with. Now, when you apply for a home, the lender will look at what's called the 4 C's of lending: capacity, credit, capital, and collateral. They want to know, can you afford to pay your debt, and can they trust you to repay the debt? So for capacity, they will look at how much you make, your employment history, and your current debt obligations. They'll analyze income documentation, like pay stubs, tax returns, W-2, and they'll calculate if you earn enough to afford the monthly payment. They'll also make sure that your employment is stable. They typically look for about the 2 most recent years of employment history. They want to know if you held the same job or worked in the same field. Do you jump from job to job, industry to industry? If your employment history is not stable, then they will record you as a risky borrower. They'll also review your credit report to see how much personal debt you're currently carrying. And this is, credit cards and loans. They want to make sure that adding the new housing payment to your current debt obligation is not going to put you at risk of not being able to keep up. This is when they do a calculation called the debt to income ratio, which we will review in a little bit. The second C is your credit history. This is based on your credit report. Do you pay your bills on time? Do you pay your debt obligations? They want to make sure there's no collections or profit and loss or charge-offs or bankruptcy listed. They'll also look for credit references on your credit report. And these are accounts that have at least a 12-month recent positive history. Now, some lenders do accept non-traditional credit references, meaning credit references that are not reported on the credit report. Things like your landlord or your cell phone provider or your car insurance company, anybody or any organization that you're legally obligated to making monthly payments to. And they also typically have minimum credit score requirements that you must meet to be approved for the home loan. The third C is capital. They'll look at your bank statements to make sure that you have enough liquid assets to cover all the upfront costs. That's the down payment and the closing costs. And they also want to make sure that you're left with a saving reserve. Now, the saving reserve that they want you to have after you cover those upfront costs is typically calculated in terms of months. And that's meaning how many months, the number of months that the lender would want you to have in housing costs, how many months you should have saved to be able to cover monthly payments for, let's say, you want to make sure you can cover monthly payments for at least 2 months or 3 months. So, and this depends on the lender, what they require. The fourth C is collateral. They'll require a home appraisal. They want to make sure that the value of the home backs up the loan amount that they would extend you. If the home appraises for less than the purchase price, then their investment is not protected. And so they would not approve the loan. And that's because if you were to not pay and foreclose on the home, they need to foreclose on the home, they will not be able to recoup the money that they'll lend you from the proceeds of the sale. Now, of course, credit history is very important. And so knowing what impacts your credit score will help you understand what you can do to help improve it and maximize your chance for approval. Also, the higher your score, the better interest rates you'll be quoted. Now, Experian, Equifax, and TransUnion are the three main credit reporting agencies. Your creditors and lenders report your credit history to them, and the bureaus then collect this data, list the information on your credit report, and then assign your credit score. The credit bureaus don't give us their formulas for calculating the credit score, but they do tell us what we do that can have a positive or negative impact on it. Now, the largest impact on the credit score is your payment history. Do you pay your debts on time? Do you pay your debts as agreed? If you have like a late payment history or outstanding debt like collections, then that will bring your score down. How much debt you owe on your credit cards has a 30% impact on your credit score. This is also referred to as the credit utilization ratio. Now, borrowers who habitually max out credit cards are viewed as risky because it's a red flag that they cannot handle debt responsibly. So a good rule of thumb is to keep your credit card balances at no more than 30% of your credit limit. This means that if you have a credit limit of $1,000, then you would not should not carry a balance that's higher than $300. And of course, the lower the better. Length of credit history has a 15% impact on your credit score. A short history does not mean you cannot have a good score, but the longer your credit history is, then the more information they have about you on how you handle debts, which can help improve it. So to know how old your history is, then you would just look at your credit report, find the account that has the oldest open date, and then that's when your history starts. New credit has a 10% of impact on your score. This is when the credit report is pulled because you have applied for credit or loan. Every time you apply, a score gets a hard hit, and your credit score, may go down. And that's because you have the potential to take on new debt without having demonstrated how well you would be able to pay it off. So it's important to not apply for a bunch of new credit all at once. Types of credit used has a 10% impact. There are 3 types of accounts that can be listed on a credit report. Installment accounts, which are loans, revolving accounts, which are your credit cards, and mortgage if you own a home. Now, you don't have to have all 3 to have a good score, but a credit mix, what they call a credit mix, can help it because it shows how you handle different types of debts. Now, you are entitled by law to pull a free copy of your credit report from each of the credit reporting agencies every 12 months. That's Experian, TransUnion, and Equifax. Before you apply for a loan, make sure you know what is reported. If there are errors listed, dispute them. If you have high credit card balances, pay them down. If there are debts you owe, like accounts that have gone into collection, pay them, fix anything that will help you build a positive credit history and raise your score. Now, to get your free copies, you would go to annualcreditreport.com. This is the look of the main page of the website. This is the official site where you can get your free copies. Now, beware of sites that look very similar and ask for payments because it shouldn't cost you anything if you order it from the official site. You do have to request each credit bureau's report separately. Now, you could pull all 3 at the same time, but if you space out your request, then you can get a copy of your credit report throughout the year and kind of check your credit history throughout the year. So, for example, you could pull, in January, you could pull Equifax. In May, you could pull TransUnion. And in September, you could pull Experian. And then in January, you start all over again and you pull Equifax. All right, so the monthly housing payment, PITIA. Now your monthly payment on the home you want, based on the home you want to purchase, can include a cost that go beyond the amount that pays back the mortgage. All these amounts can be factored in: the principal, the interest, taxes, and insurance. And this is referred to as the PITI. Now, the principal portion of the housing payment goes towards paying back the amount you borrowed. The interest is the fee you pay for borrowing from your lender. This is calculated based on your loan's interest rate. The higher the rate is, the more you'll pay for the mortgage over time. In addition, the lender can include costs that will go towards paying back the property taxes and the homeowner insurance. They will take the annual amounts due, divide them by 12, and then add that amount to the monthly housing payment. If you put less than 20% as a down payment, you will have to pay mortgage insurance. So they will add that monthly payment as well. If the home is in a development that has a homeowner association, you will have to make a monthly payment to the HOA. The lender will factor in this cost into the monthly housing payment, which will impact how much you can borrow to buy a home. HOA dues goes towards paying for things like repairs and maintenance in common area. That's why sometimes the PITI is called the PITIA, because the PITIA is when the home is in a homeowner association. Now, these dues can be several $100s a month, so it's important that you also review this cost against your household budget to make sure that you will be able to sustain it comfortably. Now, the interest rate is the annual cost you pay the lender each year to borrow its money. It can be fixed or variable. It's expressed as a percentage and does not include fees or any charges associated with the loan. The interest rate you pay depends on factors like your loan type and the credit score. With a fixed rate loan, the interest rate does not change for the life of the loan. This means that the mortgage payment, which is the principal and interest portion of your monthly housing payment, stays the same. And even though the property taxes, homeowner insurance, and HO payments will vary and typically increase over time, it'll be easier, again, as we mentioned a little bit earlier, to budget for housing costs. Now, with an adjustable rate mortgage, which is also referred as an ARM loan, the interest rate is fixed for a set number of years. Once that initial period ends, the rate starts adjusting periodically throughout the life of the loan. And I'll have an example coming up in the next slide to show you how that works. The annual percentage rate, or APR, is also expressed as a percentage, and it reflects the interest rate plus the lender's fees and costs like points, mortgage broker's fees, and other charges that you pay to get the loan. Now, two different lenders may quote you the same interest rate, but charge different fees. And for this reason, comparing one's loan's APR against another loan's APR gives you a fairer comparison of how much each loan will cost you overall. So here's an example of an adjustable rate mortgage, or ARM. Now, again, the ARM, the interest rate adjusts. With an ARM loan, you lock in a lower interest rate for a set introductory period, lower than you would get with a fixed rate loan. The disadvantage is that once that initial period ends, then your housing payment will vary and be less stable. It could also become less affordable because interest rates could go up. So here's an example. Let's say this borrower is looking into a 7-1 ARM loan. This means that for the first 7 years, the interest rate is fixed. After 7 years, the interest rate will start adjusting every year for the life of the loan. Now, in this case, if the borrower knows that they will be moving and selling the home in 7 years, a 7-1 ARM loan might make sense for them. However, this can still be risky because plans can change. Maybe after 7 years, they decide they want to stay in the home. Or maybe they want to sell, but the market is in a downturn and homes don't sell easily. Or they would lose money if they were to sell the home. If they end up keeping the home, their monthly mortgage payment will now vary from year to year. Now, depending on the fluctuation of the interest rate, the payments could decrease, but could also increase. In addition to risk ending up with a payment that's less affordable, it would also make budgeting for housing costs more difficult. They could decide to refinance with a fixed rate mortgage, but that means having to pay closing costs. Also, if the interest rate is higher than when they first took out the loan, then they would end up with a higher monthly payment for the life of the loan. So before considering an ARM loan, make sure that you'll still be able to afford the monthly payment if the interest rate increases. Also make sure you understand all the loan terms. How high can the interest rate and monthly payments go with each adjustment? How frequently will the interest rate adjust? How soon could the payment go up? Is there a cap on how much the interest rate can go up? Is there a limit to how low the interest rate could go? So you want to make sure that you get all the details. The amount of personal monthly debt that you carry impacts the housing payment you can afford. The higher it is, the less you'll be able to qualify for. So when you apply for a home loan, the lender calculates your debt to income ratio, otherwise known as the DTI. DTI is the percentage of your gross monthly income, that's before taxes or deductions are taken out, that would go toward paying the new housing payment plus the total in monthly payments you are already required to make on all your credit card with balances and any loans that you may have, like car and student loans. Now, lenders have a maximum total debt ratio requirements. Typically, that maximum is 43%, which means that no more than 43% of your gross monthly income can go towards paying all your monthly debts, the new housing payment plus your current debts. So to calculate your total DTI, the lender adds the monthly housing payment, or the PITI, plus any applicable HOA dues, to the total monthly payment you are currently required to make for all your credit cards and loan debts that are listed on your credit report. Then divides the total by your gross monthly income, and then the result is your debt to income ratio, or the percentage of your gross income that would go towards repaying all your monthly debts, your current ones plus the new housing payment. So let's look at an example. Let's say in this scenario, this home buyer found a home they want to purchase. They apply for a loan, and the lender's maximum DTI guidelines to qualify is 43%. This person's financial situation is the following. Their gross monthly income is $5,000. Their credit report shows 2 credit cards with balances and 1 car loan, and the total monthly payment they're required to make on these debts is $250. Now, based on the purchase price of the home they want to buy and the loan terms, the lender calculates that the monthly housing payment is $1,900. So the lender wants to know, can this person afford this payment? Would adding $1,900 to their current required monthly debt obligations put them over the 43% DTI? So to do the calculation, the lender adds the $1,900 housing payment to $250, which equals a total monthly debt of $2,150. Then the lender divides $2,150 by the home buyer's gross monthly income, which is $5,000. And the result is 43%. So 43% of this person's monthly gross income would go towards paying both the housing payment and their current monthly debt, which is within this lender's guidelines. So in this scenario, this person would meet the lender's DTI requirements. Most home loans are owned by Fannie Mae and Freddie Mac. They are government-sponsored entities, or GSEs, which means they follow guidelines that are set by the Federal Housing Finance Agency, or FHFA. When you apply for a home loan, you can apply for a government-backed loan or a conventional loan that is not insured or guaranteed by the federal government. All are issued by banks, credit unions, and other approved lenders. However, there are some major differences. Conventional home loans, because they're not government insured, pose a higher risk for lenders. So credit and income requirements are stricter than for government-backed loans. These types of loans are an option for borrowers with good or excellent credit and who can make a larger down payment. A government-backed mortgage is a loan insured by one of 3 federal government agencies: the Federal Housing Administration, or FHA, the U.S. Department of Agriculture, or USDA, and the Department of Veterans Affairs, or VA. With these types of loans, the government agency is not the direct lender. The agency promises to repay the lender if the borrower fails to do so, and so the lender's risk is reduced. Now, this makes the lender more willing to approve loans in situations when a borrower might not otherwise qualify. These types of loans have less strict credit requirements, and the minimum required down payment is lower. Now, to qualify, the home buyer must meet the program's guidelines requirements and must also work with an approved lender. FHA is part of the U.S. Department of Housing and Urban Development, and also known as HUD, and it aims to make homeownership more affordable. Now, FHA offers a variety of loan options that require lower minimum credit scores and down payments than many conventional loans. Veteran administration loans are designed to help service members, veterans, and eligible surviving spouses become homeowners. And USDA loans are for eligible home buyers who purchase a home in a rural area. These are areas that are less densely populated. And then the California Housing Finance Agency, or CalHFA, provides both government-insured and conventional loans programs to help low to moderate income first home buyers purchase a home in California. There are also home loan programs that have lower down payment requirements. For example, FHA loans allow a down payment as low as 3.5%. Home Ready is offered by Fannie Mae. Home Possible and Home One are offered by Freddie Mac. These programs' minimum down payment is 3%. Some loan programs like the VA, USDA, and Habitat for Humanity don't require a down payment. There are home buyer assistance programs that provide loans to help cover down payment and closing costs. They specifically target low to moderate income first-time home buyers. Payments for these loans are deferred over a specific time span, and in some cases, they're also forgiven over time. So for example, if you live in the home as primary residence for a set number of years. CalHFA offers these types of loans to California home buyers. There's also IDA accounts and mortgage credit certificate programs that can help. IDA accounts are basically what they are. They're individual development accounts. And what they do is they match your monthly savings, typically 1-to-1. Now, each program will specify towards what you can apply your savings to, but most commonly these accounts are for housing, education, or starting a business. Mortgage credit certificates are a tax credit, not a tax deduction. They reduce your potential federal income tax liability, thus creating additional net spendable income, which borrowers can then use towards a monthly mortgage payment. And as a result, it helps the borrower qualify for a higher housing payment. Now, these types of programs are tied to available funding and grants. So the best way to know if they're available in your area is to do a Google search. Some loan programs help people who work in specific professions. For example, the U.S. Department of Housing and Urban Development, or HUD, offers the Good Neighbor Next Door program to help teachers, firefighters, police officers, and EMTs purchase a HUD home at a discount from the list price. Now, HUD homes are foreclosed properties that were originally purchased with an FHA loan. HUD becomes a property owner and then offers it for sale to recover the loss on the foreclosure claim. Some cities and counties offer home buyer assistance programs designed to help people who live or work within their boundaries purchase a home. So you could check out your city or county website to see the housing department on the housing department kind of tab to see if they offer such programs. Banks and credit unions offer their own loan products. Different lenders offer different kinds of loans, so explore your options. Now, before you start shopping for a home loan, take the time to do your research. Look for available programs, understand how they work. This will help you understand all the options that may be available to you and allow you to choose the loan that's best for you. So for example, if you want to know if you qualify for a government-insured loan or a special program like the Good Neighbor Next Door, you want to make sure that you talk to a lender that offers that type of program. Now, when you start shopping for a home loan, shop around. A loan that seems reasonable at first may not be your best option when compared to other offers. So ask questions to get a better sense of what loan might be the best choice for you. Pre-qualification and pre-approval processes help you assess how much home you can afford. There is a difference between the two. Pre-qualification is an informal evaluation and can be a helpful step if you're at the beginning of the home buying process and you just want to get a sense of a purchase price that you would be able to afford. It's based on verbal information about income, assets, etc. No documentation is required. Depending on the lender, a credit review may or may not be required. With pre-approval, you have more weight. The lender makes a conditional commitment to grant you a loan. Typically, you will go through this process if you're actively shopping for a home but have not yet found one that you want to purchase. In this case, you provide documentation. Every lender is different, what they require. So you need to find out what you need to do and what they want. The lender makes a conditional pre-approval based on actual verification of income, credit, assets, bank statements, pay stubs, and so forth. You then receive a pre-approval letter, which will likely have an expiration date. And for this reason, many people wait to get an approval letter until they are ready to begin shopping seriously for a home. Now, a pre-approval letter is helpful to have, especially in a seller's market. It shows that you're serious and that you have a lender who would be willing to lend to you under certain circumstances. The letter will say how long the conditional approval is valid for, and it will include conditions, for example, that the home appraisal value meets the agreed upon purchase price. So if a lender denies your loan application, there may be steps you could take to improve your chances of approval with your next application. First, understand the reason or reasons why it was denied and address those issues. What can you do to correct them? As you work towards placing yourself in a more favorable position, look at yourself the same way lenders do. If you were denied because you did not have enough in liquid savings for down payment and closing costs, research home buyer assistance programs. Learn what's available, how they work, look up matching savings programs in your area that allow to use the funds towards the purchase of a home. Keep in mind that participants usually are enrolled in this program for a period of 1 to 5 years before they can access the funds, so you need to plan ahead. Some lenders accept gift funds from family and friends. Ask if this is an option. If the lender accepts them, anyone gifting you money will have to agree in writing that it's a gift and not a loan, and they will also have to provide proof that the money is available. If your income shows that you can't afford the housing payment, you may not be able to do a lot to grow your income right away, but there are some possible solutions. Can you work to build your savings so you can put a larger down payment or apply for a down payment assistance program? The less you borrow, the lower your housing payment will be. If your current rent amount is as great as the proposed housing payment, the lender may consider this as an extenuating circumstance. Check to see if there are mortgage credit certificate programs that you can apply for that can help you reduce your potential federal income tax liability, so that you can create additional net spendable income that you can apply towards a housing payment. Some home loan programs allow for co-signers. However, keep in mind that the co-signer will be legally liable for the debt. So if you fail to meet your repayment obligations, they will be impacted negatively. Also, it may impact their ability to qualify for credit or loan. So you must make sure that the person you ask understands all this and is willing to take the risk. If you were denied because your debt ratio is too high, review your budget. Are there expenses you can reduce to free up money that can go towards paying off debt? The less personal debt you owe, the higher the monthly housing payment you can afford. If you're denied because of a poor credit history, look at your credit report carefully. What is reported that you can fix? Are there collections that you can pay off? Late payment history you can reverse, errors reported that you can dispute. And if the application is denied because the home appraisal is too low, can you renegotiate the purchase price with the seller? You want to watch out for predatory lending. Here are some red flags to watch out for. A lender that says your credit problems won't affect the interest rate or guarantees approval. A lender that charges high interest rates compared to others. So before you apply for a mortgage loan, research rates so you can get a good sense of what you can expect. All lenders charge fee, but it's predatory lending when they charge fees that are excessively higher compared to other lenders, or they don't disclose fees up front. If the lender provides you with documents that are missing important details, or they have prepayment penalties that are excessive. So these are fees that lenders charge when a borrower pays off all or part of their loan before the end of the loan term. Now they can charge a prepayment penalty, but only for the first 3 years of the loan. And also there's a cap to what they can charge. So if it's the prepayment penalty is greater than 2 years, then look at it very carefully and shop around because you may be able to find a better deal. Also, watch out for lenders who encourage you to borrow more than you should, or that you know you can afford. Another predatory practice is changing the loan terms at closing, and steering borrowers towards a specific lender or to a certain loan product is considered predatory lending, and it's also illegal. And here are some steps you can take to prepare to reach your homeownership goal. Attend the first-time home buyer class. These are 8-hour classes that go over the home buying process in detail, that break down what you need to know and the skills you need to have to prepare for successful homeownership. Know what you can afford to make sure you're financially prepared to cover the upfront costs and the ongoing costs. If you're not currently adding to savings every month, start a savings plan, set a monthly savings goal, and add the amount to savings at the beginning of every month. Know how much you owe in monthly debt obligations. If you have too much debt, start paying it down. Check your credit report, look at what's being reported, make sure it's accurate, do anything that you can do to fix the mistakes or resolve issues that are being reported. Research available loan programs and home buyer assistance programs. The more you're informed, the better equipped you'll be to ask the right questions to lenders when you're ready to talk to them. And keep your goal in mind when you're making spending decisions. Before buying something, ask yourself, will this purchase stand in my way of reaching my homeownership goal? All right, well, we are at a post-assessment, so we gave you a lot of information. So we want to kind of help you cement this information by taking a quick knowledge check. Nevin,
Yes, I'm here. Let's see what we have learned, right?
Okay, yeah.
Okay, I am launching. We have 3 questions. Here, you can see that. Do you see the questions?
I see them. It looks like, okay, looks like people are answering, so good, so everybody sees them.
Takes time to decide the
Yeah.
kind of quiz. Okay, I'll wait 15, or I see some people are answering. Maybe they are still reading questions.
Yeah, I see they're coming in.
In the meantime, please type your question in the Q&A, so we will be trying to answer them. Okay, 10 more seconds, and then I'll end the poll. Okay, let's see what we see.
All right, so let's go over these. Let's see, what do lenders look for when you apply for a home loan? Stable income, savings for upfront costs, a positive credit history, low personal debt, and the answer is definitely all of the above. What is an adjustable rate mortgage, ARM loan? A mortgage loan with interest rate that does not change, a mortgage loan with an interest rate that adjusts periodically. And the answer is the second one, a mortgage loan with an interest rate that adjusts periodically after the first period. And the third question is, a government-backed loan is a loan guaranteed and insured by government agencies. Is it true or false? And it's true. Absolutely. Very well. Okay. All right. Well, we are at the end of our presentation. So before we start the Q&A, I just wanted to kind of tell you quickly about a workshop evaluation. Nevin's going to put the link to this evaluation, and I believe you're going to get an email with it too. It's your opportunity to let us know what you thought about today's presentation. It's anonymous, and it it helps us we do read them. We do take to heart all the comments that you make. And so we really appreciate the feedback if you can fill it out and submit it. Really easy. You follow the link, you fill it out, you hit submit, and that's it. So it's a very quick process.
Yes, I shared the link.
Oh, thank you. There it is in the chat box. Now, I also promised that I was going to tell you briefly about our Financial Education Center. This is a free financial education resource that's available to you 24 hours a day, 7 days a week. You can access it from your computer, mobile, or tablet. It has a library of playlists that cover all kinds of personal finance topics like budgeting, retirement planning, homeownership, banking basics, loans, credit reports, credit scores, a bunch of stuff. These are quick lessons that you complete in just 3 to 10 minutes. They're self-paced, interactive, they're fun. So I have a link here in the chat box that I'm going to give you. So feel free to follow it. It's there for you to use anytime. It's totally free. And we encourage you to take advantage of it. And that's it. This is our contact information. If you have questions about our housing counseling program, my phone number and email is right there. Feel free to reach out. And now I can take questions.
Thank you, Alessandra. Thank you for the great info.
Yeah. Thank you.